Today we are looking at Alphabet Inc., ticker symbol GOOG, otherwise known as Google, and it is currently trading at $160 a share. What we're going to be doing today is looking at my automated stock valuation spreadsheet, check out the Patreon, and seeing if Google is a buy or a sell once we look at the company's financials using the discounted free cash flow model, the comparable companies model, and the Ben Graham formula for intrinsic value to see if Google is a buy or a sell. So let's have a look at the stock. If we go over the last 5 years, this was gone on an absolute tear since the pandemic, up almost 200%. It had a big sell-off where it was down about 40%. A lot of people were saying the stock was done, and basically at the start of 2023 it is up almost 80% in that time to its all-time high valuation, just touching that $2 trillion mark. So very happy for Google investors where the stock has rallied over the last year and a bit. If we are to compare it to the S&P 500, if we look at the last 5 years, it's absolutely smashed it. 163% compared to 80%. And even if we bring the timeline a bit shorter, Google is up 50% compared to the market's 26%. And even year to date, it is still beating the market at 15% compared to 10%. So Google has consistently beat the market over the last 5 years. And will it continue to? Hopefully that is the question we will answer today. So let's have a look at my automated stock valuation spreadsheet, and we will start by typing in the ticker, and this will load up all of the company information for Google. And as I said before, $160 a share, market cap just shy of 2 trillion, a PE of 29.5, and if we look currently, the average PE is actually dropped a little bit, 28.2, so it's slightly higher than the market. Earnings per share of $5.43, beta of 1.05, meaning it is less volatile than the market, only slightly more volatile than the market, which is interesting for a stock that has been on this massive tear. $163 price for the target price from analysts, which I'm quite surprised that. I thought that would be higher. Normally analysts are pretty bullish on stocks. Now we have a little summary here, but let's go into the nitty gritty. Here we have the revenue going back to 2015, and you can see this is consistently growing. We'll obviously ignore the trailing 12 months here because this is the most up-to-date information. Last 5 years grown at around about 17.5% compound annual growth rate. And it has been consistently growing. That's basically what this is saying. 70, 90, 110, 136. Big jump in pandemic, although it has kind of slowed over the last few years, but not really. It had a big jump from 20 to 21, but it's currently $305 billion in revenue. Now let's have a look at profit, and a slightly different story here, but you can see it is still growing. 20% over the last 5 years. Now it did have its all-time high profit back in 2021 of 76 billion, but overall it is trending in the right direction. Yes, it went up and then down, but overall the line is still trending up, and that's where we're going to see good profit growth and good net income growth. Good revenue growth. We have shares outstanding here. Google's done a few stock splits in that time, so the website I use to get the data doesn't really handle it well, but you can see that they actually are buying back shares, which is interesting to see. So basically, if you own 10 shares of a company and there are 100 shares, you would own 10%. If the company bought back 50 shares, your stake in the company would increase because there would only be 50 shares and you'd still own 10. And that is obviously a very simplified example, but they are rewarding shareholders by buying back shares. Whether or not that is the best idea, they could invest the capital, do other things, but overall, Google's share price, if they were buying them back when the stock was, where is it here, $90 a share, and now it's 160, that's been very good for them. Next, we will have a look at assets versus liabilities, and you can see here assets has grown pretty dramatically and liabilities has also as well, but they have more assets than liabilities, which is what we'd like to see. And last but not least, we want to see free cash flow. Why do we care about this? Well, this is things Google can use to pay dividends, which they don't do. They can buy back shares, which they do, and also they can use this to invest, and it is a pretty big free cash flow monster. 25% of the last 5 years, though, it has slowed, but all-time highs of just shy of 70 billion. Let's have a look at the discounted free cash flow model. What this is a way of evaluating the company using its expected future free cash flows And let's see what it says. So currently, based on the averages, this gives a calculated stock price of $95 a share. Now let's have a look at these numbers and we see if we agree with it. In terms of revenue growth rate, yes, revenue growth rate has slowed. Big highs in 2021, so that may be a bit of an outlier. But if we look at what analysts are saying, they are expecting pretty good revenues for Google. They're saying over the next 5 years, they're probably expecting to grow around 20% a year, which is pretty high. And if we see the current year, 342, 378 on the high side, maybe $400 billion. So maybe we are probably about right. Let's just see what those dates were again. Sorry. Those dates are the 24 and 25. So if I was actually a little bit more bullish on that, and let's try and get the numbers up, about 14%, that brings us up to $104 stock. Next, we will look at the net income margins. I'm pretty happy with the net income margins. They have been pretty consistent apart from 2020 when the revenue shot up massively, but I would say about 28% is probably fair. And finally, free cash flow rate. Once again, if we take out the average on that, this is 64%. I still think it's going to be, yeah, it's still not a buy based on discounted free cash flow, but I don't think discounted free cash flow models usually like Google, which is why I also look at my next way of evaluating the stock, which is the comparable company model. This is a way of evaluating companies based on metrics of other businesses of similar size in the same industry. So we have a lot of values here, and the companies that I'm going to look at, I'll just look at these two, but obviously I think Microsoft is a pretty good example. Next, we will do Apple, and for a third one, I'll actually do Meta, but we'll also just go with Microsoft and Apple on the next slide. Next page. So what we are looking at here is we are looking at particular metrics here. We'll be comparing revenues, growth rates, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, net income, profit margins, PEG, which is price to earnings growth rate, which was popularized by, I nearly said Peter Griffin there, Peter Lynch. Basically, 1 is fairly valued, under 1 is undervalued, and over 1 is overvalued. EV to revenue, EV to EBITDA, and PE, price to earnings ratio. So let's have a look at the enterprise values. Obviously, Microsoft is the largest, $3 billion, 2.5 for 3 trillion, 2.5 trillion for Apple, 1.3 for Meta, and 2 trillion for Google. So they're all relatively the same size. Revenues, Google 305 billion in revenue, Microsoft 224, Apple with the largest of 383, and then Meta as 343. 5-year growth rate, Google is actually one of the better ones, higher than Microsoft and Apple with 17% and 14% and 7%. And then Meta is actually the best with 20. EBITDA, 100 billion, 118, 130, and 60. Net income, it is God, I can't do the maths. Third, 100 billion, 82, 73, and 39. Now, these profit margins are quite interesting. It has actually got the lowest profit margin of 24. Microsoft is the highest, 36, and then with Meta and Apple. In terms of PEG, it is the second highest, but still, these are all classed as overvalued. You cannot see my air quotes here, but it is 1.64, which is lower than Apple and Microsoft, which I'd say is more direct competitors. Now we look at EV to revenue and EV to EBITDA. We want lower numbers for all of these. It has the lowest EV to EV to revenue. It has the lowest EV to EBITDA and the second lowest PE. So according to this, it is actually a buy. If we look at EV to revenue, $220, EV to EBITDA, 170 and 187. So that gives an average of 194. Now, if we were just to compare against Apple and Microsoft, it actually puts it around about 190. So that is a buy according to the comparable company model. Actually, as well, what I want to do, so we'll go for Microsoft, Apple, and Meta. If I go back here, also check out my Patreon for the sheet. If you're still watching the video, thank you. I have 2 members, and hopefully they are happy with the service I'm providing them. I'm going to keep on adding things to the sheets so that they keep subscribing, but I want to give them as much value as possible. I will give everyone as much value as possible. So Microsoft, Apple, and Meta, if we were to compare versus Apple versus Microsoft, MSFT, and finally Meta. Let's do this, see if this is quickly. I'm not going to read out all the numbers because everyone can see it. Alphabet blue, orange, blue. Oh, they're all similar colors. Fine. So if we look at here, over the last 5 years, Alphabet is the lowest, with Microsoft being the highest. If we go over the last 1 year, It is about in the middle, 43. Yeah, so 51%, same as Microsoft, a lot less than Meta, a lot better than Apple over the last year. And year to date, it is, oops, my mouse is a bit laggy there, apologies. Meta 50%, jeez Louise. So yeah, so that, I mean, beating the market all handily, but in terms of the last 5 years, it is still 163%, actually the lowest out of the 4. And finally, let's just have a look at the Ben Graham's model. This is Ben Graham, the father of value investing, grandfather of value investing, actually. And this is the way he used to value stocks: earnings per share, PE of a no-growth company, AAA bond yield, and the current yield of corporate bonds. Current bond yield is about 5%. Let's just have a look and see what it says, see if it's changed. Nope, 5.01. And then Google, I believe analysts said it was about 20% a year. Yeah, so 90, we'll just go with 20. I don't think this will be a buy, but let's see. So $37 a share. So currently, Ben Graham would say the stock is a little overvalued. For it to be fairly valued, he would probably be looking at an expected growth rate of 25, which is not out of the question. But to really make some money on this, it would have to be a 30% growth rate. So Ben Graham would say it was not a buy. Discounted free cash flow says it's not a buy. But if we were to look at the comparable company model and look at similar stocks, it actually says it's a buy. Somewhere in the region, it'll be valued at over $200 a share. Right, guys, thanks for watching. Please give a like on the video, subscribe, check out my Patreon, and yeah, see you guys next time.